Hello everyone and welcome to another Dividend Dynamos video. In this video, we'll answer the burning question of, should you manage your own investment portfolio? The answer depends on you. Many investors have gotten filthy rich by not paying high advisor or bank fees and simply self-managing their own portfolios. It may not be as hard as you think. Be sure to watch all the way to the end because there is some very valuable information you don't want to miss. Thanks to the internet and YouTube, managing your own investment portfolio has become more accessible than ever. In this video, I'll explain the things to consider when you're trying to decide whether it's a good idea to invest on your own or whether you'd be better off with some help. And I'll explain the difference. Please note that I am not a certified financial planner, and the content shared in this video is for informational and entertainment purposes only, not financial advice. What does it mean to manage your own investments? Managing your own investments may conjure up thoughts of picking individual stocks and monitoring the market on a daily basis. In reality, there's a huge spectrum of what self-directed investing can mean, from day trading, which is the most active, to putting every investment dollar into a single target date or index fund and let it ride, which is the most passive. For most people, the passive way may probably be the right choice. The more active you are, the more risk you may take, thus the more variation you can expect with your results. If you're not careful, buying the wrong mutual funds or even non-index mutual funds or ETFs can cost you a lot of money in fees. Trusted sources, from money expert Clark Howard to famed investor Warren Buffett, recommend sticking to a tried-and-true, low-cost, long-term investment strategy. Should you manage your own investments? I've heard a lot of dismissive statements from financial professionals and media members about the ability of everyday investors to handle their own investments. The truth is that, especially in the first few decades of your career, if you're already doing a good job managing your day-to-day finances, you probably don't need help to manage your own investments. If you're in your 20s or 30s and you're ready to invest, you may want to simply put your money in a target date fund or in a mix of index funds. You may even consider an international or bond fund. This simple plan requires spending less money than you make and being disciplined over time. It doesn't require picking stocks or being an investing genius. However, if you want to take a chance with a portion of your investments, there are more online educational resources and commission-free brokerage companies available than ever. Lots of smart, financially savvy people use robo-advisors or full-service financial advisors. But if you're willing to educate yourself and if you can be disciplined, you can manage your own investments. You may even have fun, make a great return, and get satisfaction out of doing it. If you bought a dividend fund like SCHD, which pays put quarterly dividends, and you reinvest all of the dividends and then invested $10,000, let's say you also contribute another $250 per month, which is $6,000 per year, using a 15% tax bracket and a 3.42% dividend rate, along with an expected annual dividend growth rate of 3% and an annual share price appreciation rate of 3%. And if you're 25 years old and expect to retire at 65 or in 40 years, your invested monies will have grown to over $1,248,000. Your annual dividend income would be over $62,000 with total dividends of over $515,000. See, you can get rich managing your own investments. But if you plan to manage your own investments, I have some good advice for you. First, build an emergency fund before you invest. You should have money set aside in a savings account for those inevitable unplanned expenses before putting your money into investments. You should invest most or all of your retirement dollars in a target date or index fund. Pick the year closest to when you plan to retire and put as much of your investment money as possible into that fund. Low-cost index funds are also good choices. If you really want to expand beyond the target date fund, I personally like low-cost ETFs and mutual funds that track broad indexes like the S&P 500 or the NASDAQ. I recommend a mix of total stock market, dividend, and growth funds. A few to consider might be VOO, VTI, SCHD, VUG, or SCHG. You might also consider adding an international or bond fund. Also, make regular automated investment contributions. Investing is not a one-time upfront action. Get in the habit of investing a portion of your pay automatically, either every paycheck or every month. This is called dollar cost averaging. This way you are not trying to time the market and invest only when the market is down or up. You're investing each and every month, no matter what the market is currently doing. Try to increase the amount you're contributing over time. Whether you start by putting aside 5 or 10 cents per dollar of income, try to increase that amount periodically. Also, don't make major moves because of big market fluctuations. It's hard to predict when a market crash will stop. It can be just as challenging to predict when a market will stop rising. Instead, just focus on contributing your planned amount at regular intervals regardless of what the market is currently doing. Remember, you're in it for the long haul. Here are 4 of the biggest benefits of handling your own investments. Number 1, you'll pay the least amount of fees. This is the most inexpensive way to invest. If you pick one of the best investment companies, the only fees you'll pay are expense ratios charged by the funds you invest into. Number 2, it's easier than you think. Managing your own investments isn't the same as pressing an easy button, but it can and probably should be pretty simple. Number 3, it can be extremely gratifying. There's Type A individuals, which want instant gratification. Then there's Type B, which are okay with delayed gratification. It usually involves hard work, but when you're finished, you feel proud of what you've accomplished. Managing your own investments should mostly fit into the Type B category. And number 4, you'll still be able to pick individual stocks. This doesn't have to be the grave mistake that some would have you believe. Fractional shares and brokerages with 0 account minimums make it easy to control the amount of money you invest in any specific asset. If you devote an appropriate percentage of your portfolio to an individual stock or stocks, you don't have to feel guilty. Just do your research to confirm it's a good investment for your portfolio. Here are 4 of the challenges of the do-it-yourself approach to investing. First, you'll incur greater risk. You're almost always taking on more risk managing your own investments rather than paying a robo-advisor or a financial advisor to handle them. Second, it's potentially a lot more work. Even if you take a simple approach to managing your portfolio, it will still take some time, education, vigilance, and discipline. Handing off those tasks to someone else can be a nice way to avoid stress, but it could be costly. Third, emotional discipline is a requirement. Not everyone has the stomach for long-term investing. When you're watching your portfolio value going down, whether it's every minute, every day, or every month, can you sit and watch and do nothing? Or will you be tempted to sell, which can cause you to miss out on huge market rebounds? And fourth, it's easy to be overconfident. People tend to overestimate their abilities sometimes. I know, I've done it. You've probably done it yourself. In many cases, it's not that we can't do the task, but rather that we haven't put in the time and effort to unlock our ability. There's a good chance you already have the tools you need to handle your own investments, but make sure you educate yourself before jumping into the investment deep end. If you decide against managing your own investments, you can always invest through a robo-advisor or hire a financial advisor. So, what exactly is a robo-advisor? A robo-advisor is an automated investment platform that puts your money into one of several pre-built portfolios based on your age, retirement timeline, and risk tolerance. The portfolios typically rely on low-cost ETFs and mutual funds in addition to bonds and other means of diversification. Good robo-advisors charge an annual fee in the neighborhood of 0.25% plus the expense ratios of the underlying funds, which tend to be less than 0.2%. Robo-advisors aren't designed to beat the market long-term, but they do a nice job of alleviating risk and aiming for steady returns over time. What is a financial advisor? A financial advisor is a paid professional who gives you financial planning advice and helps manage your money. He or she can serve as a coach, counselor, and even concierge at various times. Good financial advisors assess your debts, assets, and goals, then work with you to create a comprehensive financial plan. In addition to managing your investments, they can work on your tax strategy, retirement plan, and more. There's an unofficial benchmark cost of 1% for financial advisors. In reality, the price varies widely. Always ask about their fees. but the all-in costs are often slightly more than 1%. There are financial advisors with several different titles, qualifications, and compensation structures, so it's important to understand how to find and choose a financial advisor. I recommend a fee-only financial advisor. Unlike other financial professionals who may earn commissions on investments they recommend, fee-only advisors derive their income solely from the fees charged for their services. This fee structure can provide greater transparency and alignment of interest between the advisor and the client, as the advisor's compensation does not depend on the performance of specific investments. Avoiding exorbitant fees is important whether you handle your own investing or outsource it. Take the time to do your research and find a reasonably priced option. If you opt to invest on your own, my two recommendations are a target date fund or a blend of low-cost index funds, just like Warren Buffett recommends. But remember, if you outsource your portfolio, it doesn't absolve you of responsibility. You still need to be mindful of the fees, and you still need to avoid making big investment decisions out of emotion. However you choose to invest, be sure to contribute new money regularly so that you're putting enough money aside to retire. The best time to get started is right now. If you found value in this video, please hit that like button, subscribe to the channel, and leave a comment below. Let us know if you manage your own investments or if you use a robo or financial advisor. We can all learn from each other's experiences. Thank you for watching. And as always, keep your feet on the ground and keep reaching for the stars.